All right, Mark Matthews is with us of Bank Julius Baer and Company. Mark, great to have you with us here. Thank you very much for your time. Appreciate it. You know, I don't know if you saw that sort of quote from Robert Buckland of Citi. Interesting way to put it. He said, well, right now, because the market in India has done much better than other markets, there's a bit of excitement elsewhere. But he's saying that positioning-wise, he would wait for excitement elsewhere to fizzle out before starting to build up an overweight here in India. I don't know if you have any thoughts around that, Mark, before we get to kind of the here and now.
Well, that seems sensible to me, but we're already overweight India. We've been so for well over a year, and we would like to remain so. Of course, there's this great debate over North Asia versus South Asia, and the debate is largely in favor of North Asia because it's massively underperformed South Asia. If you include the currency declines in countries like Japan and Korea, you truly do have distressed prices. And I was interested to see Berkshire Hathaway taking a stake of over $4 billion in Taiwan Semiconductor. They announced that last week. Those North Asian markets are heavily cyclical plays. They're basically plays on the global economy. And you might think it's odd to want to buy a semiconductor company if the chances of a recession in America are high next year. We put the chance at about 40% right now of a recession happening in America. But I suppose that the markets have already priced that in because, as I said, they have underperformed so much this year. Anyway, on balance, we still stick with India because it's not a proxy for the global economy. It's a proxy for its own economy. And its own economy is doing well, and we think it will continue to for a few more years. So despite the fact that it's expensive relative to the others, we're very happy keeping our overweight there.
All right, very happy keeping your overweight in the Indian market, and I'm sure Indian investors are happy as well. Given the kind of trajectory we've seen, we are virtually at all-time highs. Mark, but you did mention that there is a 40% chance of a recession in the US. If that does transpire, you think India will be completely insulated? If not, how does an investor approach it? Do you go all in now, or do you wait for getting better levels over the span of the next 6 months?
I think it would be quite well insulated, and the reason I say that is there's two things. The first is that foreign investors, as you would know, have not built up substantial overweight positions in India. Quite the converse, actually. And so that's a big difference between today and 2008. 2008, India, of course, went down a lot. But that's because foreigners had been buying it up for the last few years. And the second thing is, unlike 2008, if we do have a recession in the United States next year, I think it'll be a very shallow one. And on balance, enough that wouldn't really expect a lot more downside even in the S&P. Because it's already kind of priced a recession, a shallow recession in this year. And so if the S&P doesn't go into some terrible tailspin like it did in 2008, then I think people would be looking for greener pastures, and that would bring them to India. So even if there's a recession in the US, I think that India will be fine next year.
Hi, Mark. Good morning. Mark, what about what's going on in the cryptocurrency space? We haven't seen any ripple effect on the equity markets as of now, but you know, that asset class has punctured many pockets. What's your sense?
Well, I'm very encouraged by the fact that we haven't seen the contagion that, frankly, one would have expected, Nigel, because you may remember in the sell-off in June, the correlation with NASDAQ and crypto was about 0.9%, which is to say they were moving almost in lockstep with each other. I don't know why this time it's different, but I suppose that anecdotally, just the sense I have is that people who buy crypto, or I should say who bought crypto, went all in. That was their asset allocation. They were so, committed to the idea. And so I doubt they really had much equity exposure because all their big bets were in crypto. That's the only way I could explain why we haven't seen the contagion effect this time.
Mark, a dramatic fall in oil prices, right? I mean, 13% last week, 16% from the highs in November. So this is, I mean, there's been no output changes from OPEC or any big sort of disruption, etc. This is just a panic on demand, right? Demand falling faster. How would you read this plunge in oil in relation to what, in terms of impact on equities? It's positive for macros for big importers like India, but how do you kind of read the rub-off on equities?
Positive, definitely. I mean, equities don't like a high oil price. By the way, we don't think that oil is going to go down a lot. We see it broadly in the $80 to $90 a barrel range over the next 12 months. But there's no doubt that oil going down is a benefit for almost every equity in the world, apart from the oil producers themselves and the few countries that are net oil exporters. But no, it's good for us. I don't know why it's going down. I guess there's an increased sense that there could be a recession in the United States next year. I really don't know.
All right, we'll leave it at that. Thanks a lot for joining in, Mark, and have a great week ahead. Thanks for being with us on CNBC TV 18. So there is a 40%